Hello and welcome. Let's get straight to today's market action. U.S. equities closed essentially flat across the board. The Nasdaq finished at 26729, the S&P 500 at 7785, and the Dow at 53732, with all three major indices showing near zero change. The VIX held steady at 14.25, indicating that market sentiment remains calm, with no obvious signs of panic or euphoria. But while the headline indices were flat, there was plenty of movement beneath the surface. The most notable development today was a clear rotation in capital at the structural level. On one side, we had the A-share market in China, where the Chi-Next index rose 1.12%, while the SSE 50 actually fell 0.41%. Growth style clearly outperformed blue-chip weights, and this divergence was the clearest bullish signal during the Asian session. On the other side, crypto-linked assets came under collective pressure. MicroStrategy dropped 4.13%, ARKK fell 1.92%, and the Bitcoin spot ETF lost 0.82%. The evidence of capital exiting high-volatility assets is quite clear. Our morning report yesterday called for a sideways market, and that was validated. However, we also predicted that capital would rotate into gold and crude oil, and that call was proven wrong. Gold actually fell 1.16% on a 24-hour basis, while WTI crude was basically flat. The commodity haven trade simply did not materialize. This tells us that the market's core pricing driver right now is not risk aversion, but rather real interest rates and the direction of the US dollar. The dollar index is currently at 99.67, down 0.32% over the past 7 days. The RMB exchange rate has remained stable, which provides external support for risk appetite in the A-share market. But here is what deserves close attention: the 10-year Treasury yield is at 4.7%, up 30 basis points over the past 7 days. This is the most concerning suppressing factor in global asset pricing right now. If it continues to climb above 4.75 or even 4.8%, the valuation pressure on growth stocks will increase significantly. This is a variable you need to watch closely. Looking ahead, our conclusion is that the index level will likely remain range-bound, but structurally, there are opportunities to be long. The first direction is A-share growth style. The Chi-Next has now outperformed blue chips for 2 consecutive sessions, and a relative strength signal has emerged. As long as the Chi-Next holds above 3,600, this logic remains intact. The second direction is AI computing hardware, including optical modules and semiconductor equipment. We are seeing capital flows in these names, but the price moves have not yet been confirmed by reliable news sources. So this remains a watch-only theme for now, and chasing highs is not advised. The weakest direction is crypto-linked assets. The capital exodus is clear, and we recommend staying away. Our probability assessment for tomorrow is as follows: 35% chance of upside, 45% chance of sideways, and 20% chance of downside. Our strategy leans toward controlled long positioning, but with a caveat: the 10-year yield must not break above 4.8% quickly, and the RMB must not depreciate significantly. In summary, the headline indices are dull, but there are opportunities hidden in the market structure. Keep a close eye on the Treasury yield and the Chi-Next index; those are the 2 key variables to watch. That is all for today's market coverage. We will see you next time.